This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com. Hey, everybody. Welcome back to the Investing with the Whales podcast. This is your host, Jonah Lupton. Excited today's guest. So I've been following this guy for the last 20 years since I got into investing back in 2002 at Morgan Stanley. So say hi to Ron Insana. Ron, how are you?
Hey, John, how you doing?
So you're a busy man still. So you're still a contributor for CNBC and co-CEO of Contrast Capital. Is that correct?
That is correct, sir. Yes.
So talk to us about Contrast Capital. What do you guys do?
So we're using an AI platform to develop a stock selection ETF that's also going to be married to a T-bill ETF. So it's going to be an 80-20 portfolio rather than a 60-40. So that will give us some buffer, that long-term treasuries don't provide at the moment, and short-term treasuries do. And then we're using a systematic approach to stock selection based on every recommendation that's made out there in the world by people who talk about individual stocks, and we rank them accordingly and trade with the best and forget the rest.
Is it so you're talking mostly the analyst community?
Anybody who speaks about individual equities. Yeah.
Wow. Okay. Is that people that have Substack newsletters, people on Twitter?
Yes.
Interesting. Wow. And you guys you're launching that with IBM Watson?
Well, Equibot and IBM Watson do all the data analytics and signal sending. And so we're still in the process of having conversations with our ultimate distribution partners. So there's a couple opportunities there. And, we're looking for, we're in active conversations with one or two firms about taking that out as an ETF.
Is this product available yet, or it's just on the horizon?
No, it is, I would say 60 days away.
Okay. When did you come up with this idea?
About 6, 7, 8 months ago.
Okay. And I mean, it does take, I've looked at doing an ETF before. I mean, it is a 12 plus month process from start to finish.
And we have multiple flavors of this in the works as well, long, short, asset allocation and sector rotation that we're contemplating. So it's going to take some time. You know what it's like with filing. It's 30 to 40 days and commentary and all that kind of stuff, and finding the market maker to support it and do all the rest of the legwork, and then getting out there at marketing and sales, which is going to be my job.
Assuming we go a full-time job.
Yeah.
So you're on CNBC most Fridays. What do you typically talk about on CNBC?
A lot of macro stuff. I don't ever recommend individual stocks. It's not something I talk about. The only thing I'll go so far as to say is during a period like this, I'm wildly enamored of 6-month and 1-year T-bills because you're going to steal 5.25% yield while you wait for whatever it is we're going through right now to complete itself. And given that the Fed is becoming increasingly insistent that rates will stay higher for longer, and we could even see larger than anticipated hikes even this month, look, you don't have a secular bull market in equities without the Fed as a tailwind, not a headwind. And so I think, you can wait it out a little bit. You can still do all the typical stuff if you have a lot of time, dollar cost average, pick your spots, what have you, and buy your indexes, on a monthly basis if you've got 10, 20, 30 years to retirement. But, for people who are a little more risk averse, hiding out at the short end of the curve makes a ton of sense. Now, mostly I'll talk about the macro environment, Fed policy, inflation, growth, global economics and such. And we'll talk occasionally more specifically about markets, but I never get so granular as to talk about earnings and things like that. Honestly, after doing this for 39 years and you multiply that times 4, that's the number of earnings seasons I've had to cover. It's not that I could care less or couldn't care less. It's that I only look at earnings in the aggregate as a proxy for economic activity.
Okay. So let's talk some of that macro stuff. I mean, the Fed is a headwind right now. It does sound like we still have the jobs report tomorrow. We have CPI next week, FOMC meeting the week after. If jobs come in hot, CPI comes in hot, it feels like terminal rates probably going to 5.75 or 6.
Yep.
Is that kind of what you think too?
It is. And I'm a little worried about some of the early data for this year, because obviously January was one of the warmest months we've had, one of the warmest Januaries we've had on record. So it may have skewed both the Labor Department report that we got last month with over 500,000 jobs. And then we also had a hot CPI. like when you annualize the prior 6 months inflation readings, we were running at about 2.3% at almost every measure, whether it's PCE core, CPI, whatever. You've got the rent rolls that are going to bring down CPI going forward because those are coming down. So my concern here is that, inflation is decelerating, and this 1 month's data really seemed to have spooked the Fed. The unemployment rate seems to be spooking the Fed for reasons we could talk about later. I think it would be inappropriate for them to worry about it. So yeah, I mean, they're telling us, and Jay Powell went from talking about the, moment at which disinflation has begun to set in to now going to larger rate hikes and higher for longer in the space of just a couple of weeks. So you can't discount what they say, even though they say things erratically these days. Everybody, to an extent, has been pushing lately, certainly in the last few weeks, higher for longer, and I don't think you can ignore that for too long.
You think the bigger risk right now is not necessarily inflation, but the Fed going too far, tightening too much?
I mean, it's been my worry all along, in the sense that, particularly when they jumped to 75 basis point hikes, that they were fighting some aspects of inflation that clearly were transitory. The pandemic related supply shortages, and while those linger in certain areas, like some chips for automobiles, or we have a really serious shortage of housing, which has absolutely nothing to do with the pandemic per se. But we've seen shipping rates come down. We've seen container costs, all those things drop dramatically back to roughly pre-pandemic levels. And you've seen other aspects of inflation on the goods side in particular fall back to normal, or disinflate, or even deflate. And so we have some stickiness in the services sector, and we have wage inflation that is not a function of anything other than a reduction in the supply of the labor force. And raising interest rates won't address some of that. It'll just raise the unemployment rate, send people out of work, only to come back presumably at lower wages sometime in the future. I'm not sure that's a solution to the kind of structural issues that we're dealing with the labor force today.
Do you think, and I know this is, we're playing a guessing game here, but if the Fed, let's just say they raised 50 bips at the next meeting and say, we're done, we have to wait for, that's a big, I think we agree it's probably not going to happen, but, let's just say that we believe there's a effect. We have to wait for the previous hikes to catch up and see what the data looks like, blah, blah, blah. Do you think inflation on its own would come down to that 2% target at some point by end of year?
It's funny because the 2% target's become a very strange thing. Previously it was a floor. Now it's a ceiling.
Right.
So we went from having 12, 13, 14 years of undershooting on the inflation side, and really since the early 1990s, a wildly disinflationary environment, to a massive shock in so many different ways. The pandemic, the war in Ukraine, the shutdown of the economy, the rapid reopening of the economy. And we jumped decidedly above 2%, and we got to 9 and change. And now that's coming back down towards 6 or 5. And so getting it to 2, it's interesting that the Fed's insistent upon that, when just a couple of years ago, they were trying to get it above 2, and 2 would be the average, which meant for a period of time, we were talking back in 2018, 2019 about the Fed letting the economy run hot to get 3.5% inflation for a period of time, so that that average would have been around 2. Now they're making a case that 2 is the ceiling and not the floor. And so I think in many ways, it's a strange preoccupation. I think they're looking at the 70s analog, which I don't think is the proper analog, but they're fixated on not making 1970s style mistakes, which is why 2% to them has become very important. They don't want it to bounce higher if indeed they pause at some point this year.
I mean, isn't it almost a bigger threat to the economy to hike too far, slow down everything? Lending gets crushed, the real estate market gets crushed, the auto market gets crushed because people can't, they can't afford to borrow money to buy cars. They can't afford to, they don't want to buy a house with an 7.5% or 8% mortgage. And then that obviously leads to people losing their jobs.
Yep.
So we end up with millions of people out of work rather than, 3.5% inflation instead of 2% inflation. Like, I don't like inflation. I don't like going to the grocery store and paying more this week than I paid last week, but
and some of that's going away, right? I mean,
their jobs.
Catherine Rampell in the Washington Post just pointed out how big a drop we've seen in egg prices, right? I mean, so we're having this Humpty Dumpty moment in egg prices, and no one seems to have taken notice. You only notice when it's going up,
Right.
when everything falls back to normal. No
Or
one.
look at, I mean, lumber prices went
Lumber's
straight up,
crashed,
came down.
I mean,
Net
twice.
gas prices came back down.
Yeah. Oil can't seem to break $80, right? And here in New Jersey, where I live, you can get regular for $3.09. It's not an onerous price for gasoline. On an inflation adjusted basis, that's where we were in 1972. So, and as a percent of disposable income, and given the energy intensity of the economy then versus now, you're getting 20, 25, 30 miles to the gallon. Back then it was 8 to 10 to 12. It's a different
and you're
world.
probably driving a lot less now than ever before,
Oh,
right? Because so many of us work from home 2 or 3 days a week.
Yeah, absolutely. And that's where the split is. So the service sector inflation that we're seeing is in hospitality and leisure, because effectively, and we think it's a 3-day work week now in the office, right? That means 4-day weekends. So that means that people, even if they want to work from anywhere, can hop on a plane. And you've been to airports, it's maddeningly full.
Yep.
Right?
Planes are all full.
Is horrible. Their capacity is not back to where it was pre-pandemic, and that's kind of straining their systems a little bit. And hotel rates, airfares, travel and tourism, restaurants, they're all packed, they're all booked, and prices are up. And that's a bit of a structural and behavioral finance change. So that might be something we live with for a period of time, unless or until we go back to the office 5 days a week. And having 3 Gen Z kids, one of whom is employed in public relations, she's in 3 days a week. And, can take off if and when she feels like it on Friday and Monday, along with the weekend, to go do whatever she wants. So I'm not sure how much of that's structural. And again, I'm not sure how much raising interest rates will affect that behavior unless you hit a recession.
That's the new normal for a lot of companies.
Yeah. And that means a smaller square footage imprint for commercial real estate at some juncture, if this is semi-permanent or permanent. It means a lot of things. That in and of itself is, deflationary with respect to rents. In residential, we're going to see rent rolls that'll be more favorable to CPI. When you look at that piece of consumer prices called owner equivalent rent, which, is used to measure the cost of housing, those rolls are going to be weaker this year than last. And that's 34% of the CPI. So when that finally breaks, and there's a pretty long lag, because it's generally 1-year leases that are computed, they don't compute month by month. So we've seen some real-time data from the Cleveland Fed. We see real-time data from Redfin, from Zillow, showing rents, broadly speaking, coming down in major metropolitan areas. That's going to show up in CPI. And that's also a behavioral issue too, as well, in some respects.
I posted this on Twitter a couple of days ago, and granted, this is a seasonally weak time in Boston to be, for the apartment.
Doing anything?
Yeah. But I was looking at units in my building back in the summertime, looking to possibly move up from a 1-bed to a 2-bed. And I have a friend that's looking to lease in this building right now, and they're offering him the same 2-bed unit for more than $1,500 cheaper per month than what they were quoting me just 6 months ago. So
that's a big hit, right?
Huge hit. Yeah. And I re-signed a lease, and now I probably, if I was going to release this unit, probably get it 15% cheaper if I was signing that lease today versus back in November. But
we're fighting, all my kids, just not to be too personal about it, went to boarding school. So we sold our house years ago, and we've been renting while they were going through that process, while they're going through college, because there's no net benefit of owning a house when you're shelling out that kind of cash and paying property taxes that are no longer deductible,
especially you're in Jersey, right?
I'm in Jersey. So
and property taxes are insane.
So we've been renting, and, we had a great place, and, we're paying a very reasonable rate for a nice sized house that, my kids, their friends can come home to and crash at and do all that. They want to raise the rate 20% at the end of June, which we may end up having to pay.
Right. Because what's the alternative? I mean,
we can't find a comparable house for any less. And we probably should scale down because our kids are getting older and basically heading out the door. But for the next 2 years, we may just have to eat it. And rents are coming down everywhere but my neighborhood. And there's no supply. And here's a problem that people have with respect to selling their homes. They bought them, a lot of people financed at much lower interest rates than where we are today. And in 2 years, from 2019 to 2021, housing prices went up 40%. So you can sell your house, but the best you could probably do is pay the same amount for another house, even if you're scaling down. And so it doesn't make sense to sell. So there's zero supply on the market.
So Bud's moving into this building, just sold his house. It's now under contract in Beacon Hill. He bought it 2 years ago. He's taken a $400,000 loss on it.
Yeah. Yeah, there's a lot of weird stuff. My wife's a real estate agent, so but she works at very high end, like Alpine, New Jersey, which is our Beverly Hills.
Oh yeah,
it's our Greenwich, whatever.
Nice area.
It's a really nice area, and that's where she spends a lot of her time. And look, if you're an all cash buyer who doesn't really care about what price you pay for a house, none of this is relevant, and that's a different world. But for most people, for the same mortgage you would have taken out 2 years ago, you get 40% less home today.
So let me throw you a curveball.
Sure.
Do we need the FOMC? Do they
Yeah.
do they do more good or more bad?
So look, I happen not to like this particular Fed. I broadly speaking, everything from the Jekyll Island conspiracy on out, where people talked about the secretive nature of the Fed's formation, and how it came to be after JP Morgan bailed out the stock market in 1907 and never wanted to do that again. So they recreated a central bank for the really third time in US history to become a lender of last resort and a protector of the financial system and so on and so forth, and engage in regulatory activities and so on and so forth. At the end of the day, I think an independent central bank is extremely important. I think it's better than a gold standard or any other kind of hard money standard, because there's a certain degree of flexibility in policy that's required for changing circumstances, which is not true when you're on some sort of gold standard or hard currency standard, or if you're in a some sort of grid. We've seen how brittle those things become and how inflexible they are when times change. So I happen to be a big supporter of the Federal Reserve as an institution. I don't think this Fed is the most intellectually consistent group of individuals I've seen in the course of my career. And Jay Powell's fine. As much as there was a fair amount of volatility around the opinion of Alan Greenspan, I think he'd always seemed to do the right thing at the right time. And the same with Ben Bernanke and the same with Janet Yellen. I think we were really lucky. And going back to Paul Volcker before him, we were really lucky to have those four people who managed to engineer what was called the Great Moderation. It wasn't all them. I mean, there were a lot of things that created, shallower recessions, longer recoveries, and so on and so forth. But their mistakes were controllable up to a point. And some of the mistakes that were made were outside their purview. And so, not the housing bubble necessarily, but that also had a big regulatory component that had nothing to do with the Fed, right? Just like the tech bubble.
Right. That was more banks than the Fed. I mean, that was banks allowing these loose lending.
And look, I mean, it was also the OCC going out and telling everybody during the ownership, society that Bush was in favor of, to relax lending standards to such an extent that we got a 69% home ownership rate, which was a record. But that came with no doc loans, that came with liar loans, ninja loans,
no interest, or interest only loans, and
interest only adjustables and everything else. So, and no documentation, right? And we had this and then the advent of derivatives, which quite frankly, the Fed should have been much more wary of. Alan Greenspan and I used to have these arguments privately back when I was a full timer about both the existence of a national real estate bubble, which he thought would only occur region by region, and his view of derivatives was they were a diversifier of risk. My view was that they were a transmission wire of risk. I'm not smarter than he is, but I think I was right. And I think that was a lot of that had to do with regulation of the financial markets.
Oh, I mean, all that synthetic crap allowed these banks to take on insane leverage.
Yeah, and then shuttle some of it off balance sheet, even though it was really theirs. So when you looked at SIVs and things like that, these special interest vehicles that they created that were presumably off balance sheet, but if you lost money, you had to pull them back on balance sheet. There were a lot of in the weeds types of things that generally speaking, in a polite public conversation would probably bore people to tears. But there were just a lot of elements outside the Fed's purview that created some of the bubbles that we've seen. So to net out the answer to your question, I think they're really important. I think, having an independent, intelligent central bank is critical to the functioning of to the creation of a well-functioning economy.
It's just wild that, I mean, the amount of rate hikes we had to endure last year Obviously they went too low. They kept things too low for too long.
And I'm not even sure about that. There are a lot of people who keep saying that. And I think, in many ways, there's a certain amount of revisionist history going on there.
Oh, for
Because
sure.
when we were in the midst of the pandemic and we went from the original strain to Delta to Omicron to all the new variants that are out there right now that we seem to care less about. We didn't know when it was going to end. We didn't know when the vaccine was coming.
That's true.
We didn't know how long unemployment was going to, stay elevated. We didn't know how long people were going to stay indoors. So I think, they had added some extra runway, even though we had massive fiscal stimulus, in an effort not to throw us backward while we were dealing with something that had, still unknown origin, despite what Fox News says, and and other variables that I think a central bank can't necessarily account for when it's a public global health crisis.
Sure. It created a lot of supply chain problems that had nothing to do with easy money.
Right. So
shipping rates went up, or the war started in Ukraine. That's not Powell's fault.
No, and I think, the lower for longer at the time was reflective of all those uncertainties, right? And so I think they wanted us to be clear of those issues before they started to tighten. So, whether it's Larry Summers or Jason Furman or others who have been just, beating up on the Fed for being late, or, at one point it was Jeremy Siegel saying they were late. Now he's saying they're going too much. Larry Summers is pushing, a 5% unemployment rate for 5 years, and they should do 50. Jason Furman said, if we look at the Taylor rule, which is relatively obscure as far as the public is concerned, output gap measure, we really should have right now a 250 basis point rate hike to put the Fed funds rate above the presumed inflation rate. That's just batshit crazy in my estimation. I don't see it. I don't know what kind of recession they want to create to bleed out inflation. But it seems like they want some weird rerun of 1980 and 81, and that kind of the Volcker really spiking the economy in order to get rid of inflation, which was not, by the way, the only reason inflation came down. But I don't know. I think there's a real preoccupation with getting rates up, in my estimation, too high, taking the recession and, then trying to figure out whether or not inflation reaches their target. I just think they're looking at the wrong analog. I don't think this is the 70s.
Now, over the last couple of days, we've seen short-term rates go higher as Powell sounded a little bit more hawkish, makes it sound like, 5, maybe 6 is where they end up. But we really haven't seen the 10-year move up that much in the last couple of days. And is that just because the higher they have to go with short-term rates, the more likely they are to strangle the economy, bring down inflation, and then we get to rate cuts sooner rather than later?
Yep. Not only that, so suddenly the Japanese are buying U.S. treasuries for some reason again. Even in the midst of quantitative tightening, where the Fed's letting its balance sheet shrink, by allowing mortgage-backed securities and treasuries to roll off their balance sheet, we've got long rates seemingly capped at 4%.
Yep. And
then you got you've got 6-month and the 1-year bill at 5.25%, 5 1/3, and a 3-month bill somewhere approaching 5%. You got a pretty big inversion in the yield curve, which since 1968, whenever that's happened and persisted for as long as it has, and has gone as deep as it has, you've been followed by a recession 6 to 15 months down the road. So yeah, I think the long end's anticipating much slower growth down the road, and probably, a drop in the inflation readings, irrespective of what's happening here in, January and February.
Are we on a path to a recession at some point in the next 6 to 12 months?
So if you back up to when the curve inverted, right? And so Arturo Estrella, who was at the New York Fed, did all the seminal work on yield curves. Fed may not look at it today the same way, but 3-month to 10-year was the curve that was most widely watched at the Fed. That's been inverted since November. And so if you want to make that as your start date, it's 6 months to 15 months means May is when the recession could hit at the earliest, and then anytime, in the next 9 months thereafter. There's been some resilience in the economy, but we're also seeing that consumers are switching their purchases from cash to credit cards.
Yep.
We're seeing, real estate's in a deepening recession. Manufacturing is still very weak. Auto sales, because of the cost of capital, and leases are both somewhat sluggish. And the available inventory of cars is rather constrained as well, just like homes.
So what do you think? What do you think happens in the real estate market over the next 12 months? I mean, if mortgage rates stay this high, nobody's going to sell their house with an 8% mortgage. So you just don't really have any new inventory coming. I mean, I sort of feel like rents almost have to go up because no one can buy a house. They're forced to keep renting. So the owners can keep raising rents. But maybe I'm overthinking.
Yeah, but if you go into a recession and people start losing their jobs,
Sure.
Rents can't go up, right? So, and I don't know. Look, so there are people with outstanding, SBA loans from the pandemic who, if we go into recession, they took one big hit, then borrowed money that they have to now pay back, not the PPP stuff, but the emergency, disaster loans. Those have to be paid back. And what do they say to the SBA if all of a sudden their income gets, disappears or gets cut in half? It's like, hey, thanks. How about making it a grant? I mean, it's like there could be a lot of adverse consequences, particularly in middle and low income environments where, again, we're talking about people making $100,000 or more living paycheck to paycheck, nobody having $1,000 for an emergency, or a very small percentage of the population having that. A recession will hurt. And I'm not sure that it's necessary. I really am not. I could be wrong. I've been wrong about the persistence of inflation. I've been right about the goods side. I've been wrong about the service side. I was looking for a pause and a pivot. That does not look like that's going to happen this year. And I was assuming that the Fed would engineer a recession that would encourage them, if not force them, to pivot. And I don't think they care if it's coming. I think it's a feature, not a bug, of what policy currently is.
Can you remember a time where the Fed officials were out talking so often between meetings? It's like,
no.
insane.
And this is my thing about intellectual inconsistency, right? I mean, so, and I'll throw Larry Summers, former Treasury Secretary, into this mix as well, who in the space of a month has had 4 different opinions on what the Fed should do each week that he did an interview on Bloomberg, right? So Jim Bullard, all over the map. Neil Kashkari, all over the map, mostly leaning towards tighter, but he's been inconsistent. So I grew up in a different environment. In the Volcker Fed, there were only leaks, and there were selective leaks to the Wall Street Journal only. In the Greenspan Fed, there were leaks to the Journal and to the Washington Post. I spent a lot of time. I spent 10 years going back and forth to the Fed for off-the-record conversations with Greenspan. He never leaked anything to me. But when Greenspan was running the Fed, public commentary among Federal Reserve officials and district presidents was vetted by the team.
Wow.
There wasn't a lot of freelancing. Bernanke opened that up a little bit more, Yellen a little more. Powell is letting everybody. It's a range-free Fed.
You got like
free range
for
Fed.
A day.
Yeah, and I don't get that, because I think it's very confusing to the market. Even if they're saying the same things, all it does is just like you're just getting constantly pummeled with this, with this information and these opinions, and they don't always necessarily square with the dot plots. Not that I care. And then Jay himself, a couple of weeks ago was talking about disinflation, and then now is talking about maybe having to go 50 and stay higher for longer. So I don't know. I mean, I would prefer less chatter from Federal Reserve officials, and certainly a little more intellectual consistency around what it is they have to say and why they're saying it. But it seems like, I don't know if they're trying to get on air or trying to get interviews or trying to position themselves for other things, or rather than having the closed door, very secretive, secrets of the temple, type environment that we had during the Volcker years. Whether this is, whether this level of transparency is a good thing. I mean, clearly the secretive nature of the Fed 40 years ago was probably it lacked too much transparency, because we didn't even know what the Fed did in 1984, right? You'd get a confirmatory statement after it raised rates or lowered rates. You would not see a lot of the information that we see today on a regular basis. In fact, the whole industry of Fed watching grew up around the fact that since the Fed didn't tell you what they did until long after they did it, you'd look at the money supply every Thursday. You'd look at Fed open market operations every morning at 11:30 Eastern to see if they were adding or draining liquidity from the banking system. And so there was this whole industry of economists, who watched these indicators every day and every week to try to figure out what the Fed was doing without them making any statements at all.
So it's funny that you mentioned money supply, because money supply is contracting right now,
Yeah,
correct?
it's crashing, absolutely. But
How
again,
bad is that
I
for
don't know.
stocks
I
and
mean, it
risk
exploded
assets?
and didn't do anything several times in the past. We've I more closely track the velocity of money, which is the turnover of the money supply, and hasn't budged really for years. It's been at around 1 for quite some time. And so even with inflation having spiked, velocity hasn't really gone up all that much. It peaked in 2007 at 10, and it's been sitting at 1 for quite a long time. And so I don't even know what money supply or velocity means anymore. And I don't think any economist does either, because it doesn't necessarily square with the cycles that we've seen. So
What, I mean, maybe this is, I don't know if you want to answer this question or not, but with short-term rates at 5%, give or take, what is a fair multiple for the S&P?
well, I mean, let's assume that short rates and inflation are roughly equal at 5%. So Peter Lynch's old rule of thumb was you subtract the inflation rate from 20, and that gives you a fair multiple for the S&P 500. It's 15. So to give you, and Mike Wilson's talked about this at Morgan Stanley, your max downside, if you're assuming earnings decline to $200 per share for the S&P 500, your max downside is 3,000, which is 1,000 points below where we are right now.
Which would be pretty painful.
Be very painful given where we've been, right? Which means you take out the October lows, blah, blah, blah. Look, I still think we're in a bear market. I don't think, this move to the upside is a bull market, is a new bull market. I think it's as we've seen many times in the past, and certainly in the 70s, you did see a lot of this where you were slamming around violently in a trading range between 700 and 1,000. And you did that, quite frankly, from 1966 to 1984. I don't think we're going to go through the same thing again. But having said that, you can slam around for a while without going down a lot.
Right. Without breaking below 3,600, without breaking
Yeah.
above 43, 44, and just stay in this range for the next 12 months or so.
Yeah. And look, I think, again, Marty Zweig, the late great money manager, don't fight the Fed, don't fight the tape. I think, that's a great object lesson. The tape's improved, but the Fed hasn't. And so, if you're going to err on the side of picking one of those two things, I wouldn't fight the Fed, because as long as they're raising rates and increasing the cost of capital, it makes it very difficult to just throw money directly at risk assets. Having said that, and I hate to go back to this kind of hackneyed, type of financial commentary, if you are a long-term investor, if you have a long time to retirement, I'll be blunt, who gives a shit? Your dollar cost average, you buy your indexes or your whatever, mutual funds you're buying, and you sock it away for your retirement. And who cares? Because 20, 30 years from now, we'll have had this conversation, 15 times.
And if you're still working and you have cash flow at the end of every month, put your markets
You got to do something with it, right? Yeah. And look, I mean,
what the market's going straight up.
No, and you can also look, and if you don't want to commit new capital, you can park for 6 months or a year at 5%, with assuming we don't default on our debt, with no risk, right? I mean, so it's an okay place to hide out while you're waiting. It's probably not an enormous risk that you're going to miss out on a major move if the Fed's still tightening. There might be stocks you want to buy individually that look good because they've had pretty significant corrections. And, if you're looking out 3, 5, 10, 20 years, we know certain companies, or at least we think certain companies will still be here 3, 5, 10, 15 years from now. And they're just a lot cheaper than they were, a year and a half ago.
Any canaries in the coal mine that are kind of popping up on your radar right now? I mean, there's a story out this morning about Silicon Valley Bank was forced to start selling some assets. Silvergate went down because of crypto and FTX. Commercial real estate, keeps popping up. You hear about big firms walking away from deals and leases. Any of that stuff, could it take down the economy?
I mean, I think one of the interesting things that the Fed's done here is greatly reduce systemic risk by having squeezed all of the speculative excesses effectively out of the market. Silvergate may be the tail end of the crypto crunch as opposed to the very beginning of it, right? I mean, so we've seen a lot of things go away. When's the last time you heard anybody say Shiba Inu?
Dogecoin.
Yeah, Doge. So people talk about Bitcoin and Ether, whatever. I'm not a crypto fan, but yeah, Silvergate, the bank. I don't think the system is at risk. And that's the type of thing that the Fed would have to respond to with a pause or a pivot. And I think that when you look at meme stocks, you look at crypto lenders in particular, which was, I think, entirely a BS business. When you're generating yield artificially, there's some real risk there. And a lot of that's been wrung out of the system without affecting the core of the system, which is our US banking system.
Yeah, because most of the companies that were doing it are now bankrupt.
They're gone. They're gone, right? FTX is gone. Now, losing $50 billion, that's more than Bernie Madoff lost. It's a big deal. It's probably not affecting to the same extent, let's say, that the internet bubble bursting did or the housing bubble bursting did, the average individual. Yeah, there were some, young people, and there were some others who speculated in the crypto markets and probably bought the highs and yada, yada, yada. But a lot of this was rich people screwing around with these new, presumed new monetary inventions and, just getting their heads handed to them. I mean, you saw who was wound up in FTX, right? Big, well-heeled institutions that bought the genius, idea. Which I think, listen, if anybody walked into my office dressed like that, asking for billions of dollars, it would, I would certainly not be inclined, which is just a prejudice of my generation. But, I think a lot of that stuff's gone. So I don't know that there's systemic risk. There's going to be further problems if the Fed drives us into a recession in real estate, in commercial real estate.
I mean, what are you hearing in commercial real estate? Because like we said, I mean, a lot of these big companies are allowing people to work from home 2 days a week. So they don't need as much space as they had before. They're probably going to try to sublease, get out of leases. I mean, does that create some contagion?
Well, in a sense it does. I mean, and there's smaller contagion going on right now, which is local businesses that where normally you had 5 days a week of people coming in New York City. Now you got 3 days a week. So if you're a restaurant, you've just lost 40% of your weekly, of your 5-day business. That's problematic. Shrinking square footage takes time. All big businesses are talking about it. They just don't necessarily know what to do about it. There's a lot of conversation, although it's really, really hard to do in New York City, of retrofitting these buildings, increasing the supply of apartments. And that's true in Boston and San Francisco and other places. But, New York's a very old city. So retrofitting certain types of office buildings to
trying to bring the plumbing necessary, necessary. Oh my God.
Try putting in the bathroom. Yeah.
Good luck.
So there'll be some of that because we did it after 9/11 in Southern Manhattan. A lot of what used to be Wall Street is now residential.
Oh, I didn't know that. Okay.
Yeah. Southern Manhattan is largely residential around the New York Stock Exchange.
Interesting.
But again, those were buildings that were kind of really built in such a way that the conversions were easy.
Okay.
Yeah, I think there's still more collateral damage to come. My problem is I haven't been able to figure out depths and duration of the coming recession. Is it going to be a big deal? Is the Fed going to get so wound up that they're going to do what Larry Summers says and take us from 3-4 to 5% unemployment, which would hurt? It would sting, and it would be meaningful. Although 5% used to be thought full employment, it's now different.
And now we're at what, 3.5%?
Before, yeah.
Wow.
And look, but again, you still have almost twice as many job openings as you have unemployed individuals. We have a population problem, right? You have constrained immigration. You have the fact that the millennials twice have tried to go out and start families, once during the GFC and then again during the pandemic, and have been kind of turned back. So the birth rate is up a little bit, but it's still below the population replacement rate. Not that these guys are going to pop out 22-year-olds and shove them into the workforce at birth. That doesn't happen. It takes a while to regenerate, obviously. But immigration's been so constrained. 2021, U.S. population grew at the slowest pace in the entire history of the United States. So like other countries where we have a demographic issue on the labor front that, again, the Fed can't fix. They can't fix the 6 million homes that we are missing relative to current demand by raising interest rates. That's not going to fix that. So there are other issues to contend with. And I wish we had a more cohesive set of policy prescriptions and a less polarized environment, because we'd be able to go after some of these problems with fiscal and regulatory policies, as opposed to just beating the economy with higher interest rates.
So a couple of days ago, I heard a stat that we now have more $1,000 monthly car payments than ever before.
Yeah. And I was almost in that camp. I mean, I had a, look, I had a Mercedes E350, which was $800. And to get lease a new Mercedes E350 would take me 11 or 1,200 bucks.
Wow.
So I flipped to a, GLB, which is a crossover for 600, and save myself 250 bucks a month. And I don't even care,
Right.
And it's like, I probably should have went and I should have gone and gotten, a Chevy Malibu for $299.
But we know a lot of the people that have these $1,000 car payments are the ones living paycheck to paycheck, where they are now, car rich, house poor. I forget what the term, but I mean, that's not going to end well for a lot of them, right?
I mean, not if we go into recession, certainly not. I mean, listen, the good news is that wage inflation, and in my view, by the way, this is not wage inflation. This is a massive catch up for a lot of industries underpaying their employees for quite a long time, decade, right? So if the average wage now is like $23, $24 in the hospitality industry, those people were making $7, $8, $9, $10 an hour, 15 if they were lucky, you know? And the turnover, I was just talking to somebody affiliated with a very large real estate operation. The turnover in the hospitality business, particularly hotels, is something like 150%.
Jeez.
So, and like, I mean, if you were making beds and cleaning bathrooms and hotel rooms for whatever the company could get away with paying you, I think this is much more of a catch up. I don't think this is the way Jason Furman describes it, not a wage price spiral anymore, but wage price persistence. This might just be a one-time reset in wages, right? Where after decades of capital winning so handily over labor that, there was a price to pay, and we're paying it now. And as we should, in a certain sense. I mean, people being underpaid and not really being able to survive as a family of four on, whatever.
Meaning we've reset it and now we should see some stabilization.
One would hope. I mean, again, part of this is labor force participation rate still below where it was in 2019. We're still short people. So even the infrastructure bill, as disinflationary as that would be to upgrade all our infrastructure, and even some of the reshoring could be disinflationary if it were done expeditiously, we're also short people to put to work there.
Now, so why is labor participation low? People left their industry during the pandemic and just never came back.
What is it? We're missing about 3 million people, maybe more.
Where the hell did they go?
Okay, so some died, some unnecessarily. So Jay Powell pointed out that, of the 1.1 million people who passed away, 500,000 were working age.
Oh my God. Wow.
3 million baby boomers who had, thanks to, inordinately large gains in stock market and housing values, had enough to retire and say, I'm done. We went through this pandemic. Life's too short, potentially. I'm out. So they cashed out. Some are coming back, but still some are missing. 2 million women during the pandemic left the workforce to oversee distance learning for their kids while they were learning from home. Some came back, not all. So we had some losses there. And again, with immigration constrained,
right.
We're short somewhere between 3 and 5 million people. I mean, the job openings figures tell you that there are 10.4 million open jobs and 5-some million unemployed individuals. If everybody went back to work, we'd still have 5 million open jobs. I mean, so you look at this and you're like, okay, there are two solutions: comprehensive immigration reform, which lets more people in. However you achieve that, not going to happen in this environment. Technology is solving some of the problems. So whether not just AI, which is the hot button topic, but when you look at robotics, when you look at, and I use this example I was talking about this morning at an event. When you look at how quick service restaurants are revolutionizing food delivery with robotics in-house. McDonald's has an experimental shop in Texas where only people making the food, you never see them. You don't see them at the register. You go in. If you go in, it's touch screen. You pay with your credit card, and the food comes down a conveyor belt. Same for the drive-through, right? And when you have AI going, then they have voice recognition software with natural language processing. When you go up to the drive-through, you don't have to talk to a kid, right? You just say, I want a Big Mac and fries, Diet Coke. I just revealed some of my personal favorites. And then you drive through, it comes out a conveyor belt and you split. Taco Bell has a elevated store in Minnesota, 4 drive-through lanes. Burrito shoots down a tube, and you're on your merry way, right? I mean, so when you look at some of that, and you look at what Amazon's doing with robotics, they have a robot that can load 1,000 packages per hour onto a conveyor belt. A human being can't do that.
I mean,
right?
Amazon's more of a robotics company right now than it is an e-commerce company. It's
Absolutely.
crazy.
And look, so that, I mean, to an extent, and it's not unfortunate right now that solves the labor problem, because we don't have a surplus labor. If we had surplus labor, that's the last thing you'd want to see happen. It's just throwing people out of work because they can't get jobs because they're being.
We also need higher productivity from the people that are in the workforce, right?
Yeah, I think, but I'm not sure that productivity is being measured accurately because of the disruption of inputs, right? I mean, so you can't make as many cars as you possibly can right now because
You don't have any chips. Yeah.
So the car I leased. So one of the things about leasing the E350 at $1,100 was, and look, this is entirely a first world problem, and I'm old enough to roll down my own car windows, by hand. But all these new cars do not have automatic seats, right? So not only are you paying up, but you're missing you're missing a convenience that would otherwise be there in an expensive car. And that goes all the way up the chain, right? To some of the most expensive cars. Right now, they're missing the chip that would allow you to have an automatic seat because they're using the chip for other purposes. So
my first car was an '86 Ford Bronco, and I had to crank the window down. So
mine was a four-door tan 1979 Chevy Nova, for which I paid $2,000 at 20.5%.
It probably no air conditioning either, right?
Might have had air conditioning and had a radio. I don't think it had a tape player yet. No cassette.
And it definitely had a cigarette tray. They all did.
It absolutely had a cigarette tray, but it did not convert into a phone charger. I was not driving around with a phone. If I wanted to talk to somebody, I had to stop and hit a payphone and drop in a dime or a quarter, whatever the cost was at the time. So, yeah, but I mean, so how do you measure productivity when you can't maximize your output because of a shortage of materials? So, man hours worked and output, you might have the regular number of man hours, but you're making either a different product or you're not maximizing your output. So I think productivity is being mismeasured. I think that's the short answer around that. And look, for economic growth, you need labor force growth plus productivity growth equals GDP growth. So you can't bust out a potential unless you have both those components running at the same time.
Now, we talk about the layoffs in the big tech companies, cloud software. Are they happening anywhere else in any other industry?
Not nearly as much. And look, and again, some of this is like idiosyncratic, right? I mean, Meta overinvested in something that was never going to make money, not in the form that it developed it, right? I mean, who cares if you have an avatar? If my avatar looks like me, I'm not going in the metaverse, man. It's like I already have this, right? And I'm never getting rid of it, sadly. So, if I go in, I want to look like not even Brad Pitt's too old to look. Zach Efron, or I don't know, some other kid.
Brad Pitt's kid.
Brad Pitt's kid. Yeah, exactly. And so it was a weird experiment that cost tens of billions of dollars. And so they're letting thousands of people go. Amazon overhired during the pandemic. Peloton overhired during the pandemic. Zoom overhired during the pandemic. And you're seeing it at Microsoft, and you're seeing it at some other places. And when you add all those up together, it's several 100,000 layoffs, which is one bad job month.
Right.
That may be offset by other hirings. So that's not the stuff of recession. And it's also relatively industry specific. And so we haven't really seen broad layoffs. I mean, there's some coming in retail because there's, some bricks and mortar stuff that's just not working. There's some, internet retailers that are struggling because they don't have the right product mix.
But you're not seeing in travel or hospitality.
Quite the opposite, right? I mean, they can't find pilots.
Right.
They can't find mechanics. They can't find luggage handlers. They can't find service people. Half the delays that we see are because they're just understaffed.
I mean, even recently, I went to a restaurant the other night and they had 2 or 3 sections closed down. And I asked them why. And they said, it's because we just don't have enough. We don't have enough people working. We can't open up all of our sections.
Yeah, a buddy of mine runs an Italian restaurant down, not too close from my house. And we haven't spoken for a while, but last year he was paying dishwashers $18 an hour, and they were splitting Burger King, for equal or better pay.
Yeah. I mean, I started washing dishes at 14. I was making $5 an hour if I was lucky.
I started babysitting for $1 an hour in 1976. So, and that was meaningful.
These kids don't know how good they have it. Like,
well, listen, I keep saying when I come back, I want to be my children,
Seriously.
But yeah, my youngest daughter is applying for an internship right now that pays $19 an hour, which on an inflation adjusted basis from when I was her age, it's probably $1.90, or $2.15, whatever I made at McDonald's for 4 weeks. My first experience at work at McDonald's, I think the minimum wage was around $2 an hour, maybe somewhere in that neighborhood.
Wow.
And I was working at a McDonald's in Northridge, California that had 90 kids. So you had to work your way into rotation. And so my first 2 weeks, I got 4 hours and I think I netted like $6. I spent my first check on lunch and then quit. And so, yeah, but I mean, so that, there are a lot of quirks, in the economy right now. One of the things I've been saying lately is that I think the economy is so not broken, but broken apart into so many subsectors, as it always is, but they're operating independently of the macro world at the moment. Travel and leisure is absolutely on fire. Restaurants, assuming they're not losing their, breakfast and lunch traffic, doing really well. Travel doing really, really well, even outside the country.
Well, we've switched from goods, right? Everything was, all the
Right.
goods companies were hot during the pandemic, and then everyone bought all the stuff they needed, and now they're out traveling and going to restaurants and going to bars and concerts.
Yeah. So I've got a gym in my garage that I bought. It took me 5 months to get it during the pandemic. I don't use it anymore because I'm back at the gym.
Right.
So my daughter, who's a swimmer, will come home and use it during her, off-season periods.
And the gyms are packed again, right?
Absolutely.
Yeah.
Yeah. And nobody's, 3 people are wearing a mask.
Yep.
And,
Same
it's kind of back to normal, in that sense. And so, and the
it
kids
is
are
hard to
out.
believe that just a year ago in Boston, I still had to wear a mask. Like it feels like it was so long ago at this point.
And like I was a mask wearer, and
Me too.
I thought that the mandates were perfectly fine. I didn't get in all this, freedom
Nope.
nonsense. This was a health issue, and even if they work selectively for me, that's really all I cared about. I mean, and if everybody had felt the same way, as opposed to it being some sort of unusual burden, or, which, by the way, we did this in 1918 as well. People wore masks or cloth coverings during the Spanish flu, incorrectly named though it was. They wear them in a hospital for a reason, right? I mean, it's if you can slow the transmission, what's the big deal? And it got turned into this ridiculous political thing. I'd wear one today if it was required. I wouldn't care.
I moved in with my parents during the pandemic, and I wanted to protect them. I didn't want to
Absolutely
get sick and then get them sick and be responsible for it. So yeah, I agree. I had no problem with it. I thought,
but yeah, we're freer now. We're kind of so, and with that freedom, very few people are wearing them on planes anymore. I do on occasion. And then because we've lowered our guard, even though there's another variant that's ripping around the country right now.
Which you don't even hear about.
Which you don't hear about. You really also don't hear about Ukraine all that much. And you don't hear about China, and you don't hear about a lot of things that should be top of mind and leading the news. And yet, for some reason, we've kind of gone to sleep on a lot of big things, which, may or may not be relevant at some point in the future. Hard to tell. Those exogenous issues, you can talk about, but you can't predict. And so it's really hard, like the pandemic, we'll never be prepared for the black swan. In fact, if you identify a black swan, it's not a black swan, right? So
last question, commodities. I've heard stories of China starting to hoard rare earths and copper and other commodities. Is that going to be an issue over the next couple of years, you think?
I don't know. I find, and I've said this for over a year now, I think China's uninvestable, but it's tradable. And so, yeah, maybe they're going to rebound. Maybe they're going to grow faster than people think. I don't know that they're going to hoard commodities, because they still have a massive oversupply of unoccupied homes. Yes.
They're like blowing up empty buildings.
Well, and so this is so they've got a bridge on the River Kwai economy, right? I mean, you finish it, you blow it up, and you build it again, right? And it's just to keep people busy, right? I mean, and employed. And so that might be one way that they get through this, which is to destroy it and rebuild it. They also have a huge debt to GDP issue that nobody talks about. But yeah, they might hoard some commodities because of the competition in high tech with the US, and they want to be an independent leader, and we're cutting their supplies off of certain types of chips and other, inputs that they need for, much more advanced, tech ops and military ops. So I don't know that I've never been a grand super cycle commodity guy. It's happened once in my experience, right? And the times where it has appeared to have happened more than once, it's really been in oil. It's not really been in commodities, broadly speaking. We had this really weird thing with lumber. You 1,500 and then 1,600, and then you crash twice to 300 and something. I don't know what the hell it was about, right? I mean, is lumber really in short supply, or if we ever lifted the tariffs on Canadian lumber, prices would go down even further.
Does China still own a lot of our debt?
So yeah, they got a couple $1 trillion, and honestly, what are they going to do? Sell it, spike interest rates here, drive us into a recession, and have nobody to sell to? They're still as dependent on us as ever, no matter what anybody says. In the great financial crisis, when we contracted about 8%, their exports fell 35%.
Wow.
Global trade is very slow right now. And
yeah, I mean, you've heard it. I mean, freight rates are way down. You hear the number of ships parked outside of the port of LA. I mean, it was
some of that
digits at one point, and now there's like none, I've heard.
Yeah, but some of that's because they're going to the East Coast instead of the West Coast.
Okay.
There's a little of that. But yes, net, you're down about 80-90%.
Wow.
And so, China, I think, China to me is just a stretched out version of Japan in 1989. They're over levered. They have some strengths. I don't think their model is one worth emulating, where increasingly they're putting a stranglehold on their population in a variety of ways. I don't know how you expect those people to be productive, right? And you've seen the younger generation there reject materialism with the so-called lie flat movement. They don't want to go to work. And they're short people, right? I mean, they have 1.4 billion people, but they don't have enough young men in the labor force to support the economy going forward. And as much as they altered the one-child policy to now 3 children, no one's having kids because nobody can afford them in China. And they're flat out saying no.
Huh.
So I think, I don't know when they tip. I mean, to me, it's also, on the one hand, it's like Japan. And on the other hand, it's like worrying about Russia in the 50s, 60s, and 70s, which is that when they bust, and this may be true of us as well at some juncture in the future, when they break, they'll break from within. Right. I mean, I don't think China is a stable structure. They can manufacture growth for a while. They can't do it forever. Nobody ever can. And I think some of the things that they're doing are entirely antithetical to growth. Right. I mean,
and we're not buying their exports at the same volume we were a couple of years ago.
We're close, but I mean, if we slow down, we won't. And there are certain things that we won't be buying from them. If indeed they were to invade Taiwan or do something like that.
Oh, for sure.
That's a game over moment for the global economy, for some extended period of time, because they just have the entire architecture of the post-World War II trade system break completely.
So that's one of the black swan events, I suppose, for the markets, right?
Yeah, we know it's there, and we some are speculating that it's coming. The question is, it's more of a black swan if they don't invade Taiwan, right? I mean, because everybody thinks that they're going by 2025 or 2027. That's the current military thinking on this.
So we'll end on this question. If the markets were to go back down and retest the October lows, or maybe even break them, what do you think? What was the reason?
Fed went too far.
Okay.
And other central banks around the world are doing the same thing. You get a back the truck up moment when the Fed stops and starts cutting. Short of that, you have to be very selective. You have to focus on quality. You have to focus on cash flows. You have to focus on the real fundamentals of what each individual company is doing. And again, while you're waiting, you can reap higher yields at the short end of the curve, and kind of take your time about it. You don't have to do crazy stuff. And so I think it makes sense to still be patient. Panic and hope aren't strategies, right?
Yeah,
so
and cash finally pays.
And cash finally pays. So, and look, it was only 2 years ago that we were bitching and moaning that you couldn't get a return on cash.
Oh yeah, like half 0.5%, right?
Yeah. Now you're getting 5.25%, 5.33% on what should be, again, assuming no default and really crazy stuff happening in the U.S. in the next 6 to 8 months. You're getting a guaranteed return of capital and 5% plus, and you don't pay state taxes on that. So not horrible.
Ron, thank you so much, man. Really great to catch up with you. I've been watching you on TV for 20 years and finally got the chance to say hi.
That's okay.
So.
you caught me in the back half, the back 9 of that one. But almost 40 years.
Congrats on the upcoming launch of the investment product. Sounds like it's probably going to be an ETF, but feel free to come back and give me more information once you have it.
Love to. Thanks for having me. Appreciate it.
Thanks, Ron. Have a good weekend.